Good afternoon. We'll now call the meeting of the Waco City Council acting as the Budget and Audit Committee on September 8th, 2020 to order at 1:32 p.m. Joining me online today are Mayor Pro Tem Andrea Bearfield, Councilmember Hector Sabito, Councilmember John Kennard, Councilmember Darius Ewing, and Councilmember Jim Holmes. On March 16th, 2020, the governor suspended various provisions of the Open Meetings Act pursuant to his state of disaster authority. The change was effective March 16, 2020 until further notice or until the state of disaster declaration expires. In accordance with physical distancing guidelines and while providing as much transparency as possible, this meeting will not be open to the public. This meeting is being broadcast live at wccc.tv. The audio is also being recorded. The video and audio recordings will be available to the public. According to the governor and attorney general, statutes that may require face-to-face interaction between members of the public and public officials are suspended, provided, however, that the governmental body offers alternative methods of communication with their public officials. This includes public comment on agenda items. In an effort to allow for as much public input as possible, those who wish to submit their written comments on a listed agenda item were asked to submit their comments to the city secretary's office by 11:30 a.m. today. The city secretary will read into the record the comments submitted for items on the agenda at the appropriate time. Our first item of business is to approve the minutes of the Budget and Audit Committee regular meeting on July 14th, 2020 at 1:30. Are there any corrections there? They will stand approved as submitted. Next, we will turn to the first discussion item, which is presentation by and discussion with the city's investment advisors, Patterson Associates, including proposed updates to the city's investment policy. Bradley?
Thanks, Mayor and Council. Esmeralda is going to add in Linda Patterson to our discussion. Linda is no stranger to the City Council. She's been our contracted investment advisory firm since July of 2017. She's joining us, it looks like, from her home office in Austin, I presume. And Linda's going to be discussing an update to our investment program and potential updates to our investment policy. Linda, take us away.
Okay, good morning, or good afternoon, I should say. It's always a pleasure to be with the committee and to answer any questions you have. I've been working with staff to make sure that we present an overview today of a little bit about the economics that are affecting your portfolio, but then a good look at the portfolio and what's been happening with it. So if you'll bear with me a moment, I will get the share screen working. All right, hopefully you can see the screen at this point. As I said, what we want to do today is give you a brief idea of what's happening in the economics and perhaps what's going to be happening to your portfolio. It's difficult to talk about these rates and what's happening optimistically right now, but there are some good things happening. And then we'll go through the investment portfolio and the policy changes that are being recommended to the committee. First of all, I wanted to just, I know that you're all familiar with what's been going on. We've been in a cycle of reopen, resurgence of the COVID, and that's done quite a bit to the economy. But we do have a lot of positive things. I'm not going to go through all the statistics here, but some positive growth going on. It also, though, I think has exposed some fault lines because of the massive job losses and because what it's doing to small business. And that has really affected confidence. And when confidence goes down, of course, the consumer doesn't consume as much, and we are a consuming economy. I think it's good to remember that upper right graph and about the Fed assets to GDP. The Fed and both monetarily and fiscally, the government has been adding a lot of debt, and that is something that we're going to have to live with for quite a long time. Some of the fault lines you can see in that graph on the bottom right, and you see that the unemployment is affected tremendously. by education. And unfortunately, that may be part and parcel of what is adding to some of the unrest and some of the lack of confidence, and even to the point of some of the demonstrations that have been going on. The most important thing that's been happening, I think, to drive this increase, to drive whatever good we see in the economy, is the monetary and fiscal efforts that have been going on. Fiscally, of course, Congress is 60 days before the election. It's hard to talk about anything that's certain. We have a definitely are going to have another stimulus program, but that's anywhere from $1.5 to $3.5 trillion in addition to what we're seeing now. So that's going to be a major move for the economy. But the Fed, I think, has been, in my opinion, kind of the first responder here monetarily. They've been working on liquidity ever since March. And they've opened several facilities, including municipal, commercial paper, primary and secondary, to make sure that we don't have the market seize up, which would be catastrophic. And I wanted to mention three things that are happening coming forward, which I think will affect the portfolio, it'll affect the economy overall. The first one, not so much. The Fed has come up with what's called the Strategy on Longer Run Goals in Monetary Policy. Powell is very much for transparency. And as such, he has presented this to make sure that the Fed is as transparent as possible. But the Fed has two goals, and that is full employment and control of inflation. And where employment is affected more by structural and broad-based elements of the economy, the Fed is now going to concentrate on inflation. And what they have come up with is what's called, I'm sure you'll hear a lot about it, the FAIT, FAIT, which is a flexible inflation, average inflation target. And so they're going to break away from that 2% target that we have always had, and they're going to let the economy run hot or run cold. Obviously, the market doesn't like that because they like to know pretty precisely where the Fed is going to react. But this is a major change that's coming up, and I think you'll hear a lot more about it. Another thing they're doing, which will affect the city's portfolio, is yield curve targeting. And what that really means, it was used in World War II to support the war effort. And what it means now is that the Fed is going to control a little bit more by their buying of additional assets, the short and medium term portions of the curve. Powell wants those rates as low as possible. And he's now where he can usually control the front end, and by assets, the long end. Now he's going to try to control the whole thing. So major changes coming down the line. And the changes that have been taking place, along with what COVID has done to us, is shown here. I call it to be or not to be, because we are not going to have a bounce back situation. It is going to be much longer. It's more like a U. And you can see, and you'll see later in the portfolio, exactly why you have more liquidity right now than anything else. And that's because you can look out the curve all the way to the 2-year area, and it's basically flat at a resounding 0.1 basis points. Or 10 basis points, 0.1%. And there's not much value there except what we can grab every once in a while in agencies. And hopefully now with the change in the policy, municipal debt. I wanted to just look back here. You know, we were a year ago in front of the committee, we were talking about this kind of situation in the yield curve at exactly the same time. Obviously, the curve was going down, but we didn't expect the kind of drop that we had. And I threw these in just at a broader look at Texas statewide. I thought the committee might be interested in this. And this is why I say that there is a lot of bad news out there, but it's not as bad as it was. There's a lot of positive things happening. You can see on the lower right, which is credit card spending, moving slowly up, trending forward. And on the upper left, the leading index, these are both from the comptroller's office, not you've seen a lot of growth between May and July, and then July itself showing us a little bit of growth all the way across, even to the help wanted index, which unfortunately is still lagging. Economically, what this does to Waco, as far as the portfolio is concerned, is that it was imperative that we moved as quickly as possible in the fourth quarter of 2019 and the first quarter of 2020 to lock in rates because of what's happened. Now, what's going to happen probably is that the overnight rates may stay at zero until 2022. That doesn't mean that some of the shorter rates won't go up. It just means that the Fed is going to keep their foot on that pedal on the overnight rates. So extensions have been necessary, but sometimes we have to jump over that 2-year period to try to get some value where you saw the curve going back up there. The portfolio itself, looking back over the last year from June of 2019 to 2020, you can see exactly what the market's been doing. The book value and the market value staying relatively stable with the movements that you would expect in cash availability throughout the year. The WAM, or the weighted average maturity, we have tried to keep as long as possible as we can grab some of that value out there. And under the yield block, I think it's interesting to watch that it's the liquidity that's pulling you down, because the non-cash portion of the portfolio where we can actually find some value in securities has been holding through, and we're just fighting to keep it up around that 0.9. But the benchmark shows it all. The yield in the portfolio staying close to the benchmark, but as the liquid rates have dropped down, the benchmark for June of 2020 is a 17 basis points versus what the city has been able to hold on to at a 0.649. The earnings, and I'm sure all the council members are interested in this, the earnings, of course, are a result of what those rates are doing to you. Last year, this time, 7.3 million. This year, 4.6. So significantly lower than last year, probably ending up the year close to between $5.5 and $6 million. We still try to work for a good diversification, always in the portfolio, spreading that risk. Although you can see right now that the main portions of this pie are sitting in liquid facilities, that Techstar and Texpool Prime. The difference with the Texpool Prime, of course, is that it owns commercial paper, and commercial paper will give us usually 20 to 30 basis points above the governmental securities, and still holding on to the agency notes as much as possible. On the bottom, you see why we try to hold on to those, but they stand at 0.899 on the agencies at the end of the quarter. And you can see the difference. Look at the pools going from 1.003 to 0.21. 1.3 to 0.5, 1.5 to 0.1. It's a very, very drastic change in the rates that we see. And as such, you have to react to it on the portfolio. Those agencies that do represent a large portion of the portfolio, we also try for the diversification there. So you can see that we have Farmer Max, Federal Home Loan Mortgage or Fannie Mae, and Federal Farm Credit. Now, 77% of the agencies are callable, and that means they probably will be called, although it's so flat now they don't get much of a reprieve by calling them. But you get a little bit of additional yield there. And as they get called away, we just keep adding more agencies into it. And try to maintain a good diversification between the issuing agencies.
Linda, sorry, on 2 slides prior on the allocation diversification, what's that First United Bank? Is that cash or is that a CD or?
No, it's cash.
Okay. Just a straight cash account money market?
Yeah.
Okay.
And Janice would have to tell us exactly. I'm actually pulling a zero here on why we have it sitting there. It's a very small portion of the portfolio.
This is Rusty. If I could, on the First United Bank, I just want to make a comment to that. Those are money market or now accounts at First United Bank, and their development funds related to the Riverfront project are in those accounts.
Okay. That answers that. Thanks, Rusty.
Yeah,
And then one other quick question while we're looking at these yields. So once some of I know you're trying to keep the average maturity as long as is feasible and reasonable. Once some in the non-cash with the agencies you've shown are yielding almost 90 basis points right now. If our benchmark stays where it is and rates stay where they are, what realistically with the benchmark of say 17 basis points, what could you kind of expect our portfolio to yield, or kind of where's your target, assuming rates stay where they are?
I'm hoping that we can, by using the agencies and also the change in your investment policy, which opens it up to GO debt, municipal debt, that we can keep it at a 0.5. I expect your benchmark will still stay around the 17 or maybe even go a little bit lower.
Okay. Thank you.
This should be no surprise to you. That's obviously because of that straight flat end of the curve, that you have more sitting in the overnight position than you did back in March. And you can see that we're jumping over that high liquidity level will cover your liquidity needs out to 3, 6, 9 months. And then that's where, if possible, we can find some additional yield, some other securities that are available. I might mention one of the things that is good about the municipal debt right now is that it does provide some additional earnings over the agency notes and definitely over Treasury, which is just outrageously expensive. But the problem with it is for a large portfolio that it's difficult to get large blocks of municipal debt. Because obviously they're not issuing as much as the US government is. But we're going to give it a whirl and try and see what we can find. You'll remember that when you look at the portfolio, if you look at the total portfolio, that is the bond funds, TWDB, Ritchie Road, the bond funds and the others are kept separate and managed separately because of their different needs, requirements, restraints, and cash flows. And there hasn't been very much change between March and June here, just a normal spend down during this period, but in a relative basis, pretty much the same across the board. You can see that 2016 bond issues and the 2017 bond funds are all slowly going towards zero here as they get spent down. Interest earnings reflect the same thing. This is, you're looking at the fiscal quarters for 2019, 2020, and how they're coming in. 2015 is on this graph because there were earnings during the period, but obviously not enough to even show up. Your policy has guidelines for compliance, for diversification, and this is the first time that we've ever exceeded that. Obviously, it's not a dangerous situation because it's 100% cash, and that's because of the need for the liquidity, where normally in a normal situation, you would never have more than 50% cash, and that's what the guideline is. It's not a hard standard in your policy, but it is a good guideline for diversification. And it shows here that, we've got that little bit sitting in the bank, but the pools and the money funds where that liquidity can actually give you some benefit and guard your liquidity is the biggest section of the portfolio. Going forward, hard to say, but the Fed funds are really anticipated to stay at zero. It's actually a range from 0 to 0.25% right now, but it is basically sitting at zero. And this is probably going to be where that overnight rate is going to hang until the end of 2021. That's the Fed's pronouncement. We would have to have something major, like a major reopening with a vaccine and everybody back to work in order to break that cycle. And the Fed, as I mentioned, is going to be controlling the yield curve a little bit more. So I anticipate, excuse me, I anticipate that the short end and the medium part of the curve, which would be from the 3 month out to about the 2-3 year area, that they're going to target that to try to keep that very low. So that's going to be very difficult for a portfolio that is actually an operating portfolio. Extension, as I mentioned before, we want to get those on there in order to jump across the creek and out to the 2 year area to try to find some value. But of course, the liquidity needs of the city come first. So you can only move so much of the portfolio at any one time, one, because of availability of the securities that are available, but also because of the cash flow, and more importantly, the cash flow. So the rate is dependent upon that. That's best guess, as I mentioned before, at a 0.5, and hopefully better than that. There are some recommendations for changes to the policy. These have been reviewed by the finance department, and we think that they're reasonable and continue to show best practice in the portfolio. The first one is in the authorized investment area. And this was a repurchase agreement. And a repurchase agreement, of course, is a buy-sell transaction, very, very safe, done delivery versus payment. And we're talking here in the change of extending from 30 days to 90 days. All that does really is to give the portfolio a little bit more opportunity should the repo, which is very often an alternative to short agency paper, discount notes, that when that comes back again, we may be able to put a little bit more and a little bit longer into the repo. The most important change, I think, is that we are in the recommendations adding state and local debt. And it has been qualified as general obligation debt, which of course carries the taxing capabilities of the issuing municipal agency or state agency. And in your policy, it will have a minimum rating of A. It will have a 3-year maximum maturity, which is the maximum maturity for anything in the portfolio. And in the diversification limitation guidelines of the policy, 20%, so that no more than 20%. And because of the size of the block sizes in municipal debt, I sincerely doubt whether it will get anywhere near 20%, probably staying closer around 10%. But that will be the diversification guideline that will not allow undue or over concentration in municipals. The policy certification, this has been
Hey, Linda, I'm sorry. This is Hector. I just have a quick question about the diversification guideline. So
Sure.
Are you saying the maximum is 20%? It can be way below that, but the maximum would be 20%.
Exactly. Okay.
Thank you so much.
Sure. The policy certification was changed by statute a couple of years ago. It used to be that all brokers and pools and banks had to certify to the policy. Now it's simply the policy, the pools themselves that have to certify. And your policy had an exhibit on it, which had the city's certification language. But since now it is just the pools that are certifying, they all obviously have very specific letters that comply with state law that when they get your policy. So we've taken the exhibit off and made sure that the policy says exactly what it's doing. It's going to get certification from the local government investment pools. What was also added was that, and in practice this is already being done, that your investment advisor would always certify to the policy. The bank collateral requirements, when the FDIC closes a bank, when there's an event of default and they step in, they're looking at the official records of the bank. And that means it has to be on the minutes of the bank board or the bank loan committee. So the language change in here is so that the city will always know that that bank board or bank loan committee has satisfied the requirements of FIREA, which is the Financial Institutions Resource Recovery and Enforcement Act, and that they have satisfied that so that you always will have a clear, absolutely clear ownership of the pledged securities. And that you would have approval of the custodian. You never can, a city can never choose its custodian for collateral, but they certainly should have the ability to approve them. You've had some title changes in finance, so the positions have been, the names of the positions have been changed, and a trading provider, which the committee or the city council can approve and must approve before the city can use them for the investment training. The Alliance of Texas Treasury Associations has been added to that list. And the last thing, because it's attached to your policy, is an update of the broker-dealer list. This is your broker-dealer list. We have a number of them, and they're chosen basically because what they're offering, where they have specials and so forth. You'll see some of these are italicized, and that's because Wall Street seems to be changing its names on a lot of their firms. FTN has become FHN, International FC Stone has become Stone X, Piper Jaffray is now Piper Sandlin, and Williams is now Siebert William Shank. There's only one new broker on the list, and that's Robert W. Baird. And one reason that we added them is that because they're very good about finding municipal debt. And now that you have that in your policy, that's you want to have a good source that's available. And that wraps up my comments for the day. I'd be glad to answer any questions.
Thank you, Linda. Any questions from council or comments?
Only other one that I have. Okay.
Go ahead, John.
Okay, yeah, just a quick one. Remind me in our policy if there's a constraint on the average maturity of the portfolio, how far out you can go?
Yes, your average maturity is 1 year. Your maximum maturity for any security is 3 years.
Okay, that's online. Yeah, no, that's it. I think good report. And if you can hit 50 basis points on this whole thing in this climate, way to go. Looking forward to that.
Yeah, I had the same question as John there, but also, yeah, great presentation. And it's been, the yield curve is so flat. And I guess I don't mind it being flat when it's 200 basis points, but when it's 10 basis points, it's tough. Yeah. But I appreciate your management of this portfolio. One other question I had, have we ever done, has the city of Waco ever had state and local government debt obligations in its portfolio before?
To my knowledge, to my knowledge, no.
Okay.
This is
I was just curious. I mean, and it seems like we're putting some guardrails around it with the rating and the max maturity and the maximum guideline there at 20%.
Right.
Well, and the GO requirement is the one that matters to me the most. So
That's the big one. And, you know, you can get revenue bonds, but and we watch and vet any issue that we buy. And on the revenue bonds, there are just too many questions, you know, that if it's a toll road that doesn't, like now, doesn't get very much revenue, or a bridge to nowhere, that's not a situation where the city wants to be. And that's why we stuck with the GO.
Okay, thank you. That's all I had.
Anyone else? All right, thank you, Linda. Very good presentation. We appreciate you being here and appreciate your work for the city.
Nice to see you all. Stay well.
Thank you. Our next item is a discussion of capital improvement programs, budget development, including timeline, process parameters for debt capacity projections. I believe this is Paul Kane.
Yes, sir. Good afternoon, Mayor and Council. Paul Kane, Assistant City Manager. Esmeralda is going to be pulling up the presentation for me. Hope you're all doing well today. Had a good holiday. Thank you, Esmeralda. As the Mayor mentioned, I do want to talk to you about our CIP calendar and talk a little bit about our bond capacity parameters and try to get some things narrowed down from you as we move forward towards a debt sale in the spring. So a little bit of background is, as council knows, the CIP development has typically been and traditionally been part of the budget adoption and the same process that we use to put together the operating budget in terms of time and calendar has been part of the CIP as well. Then after that, after the budget's adopted, traditionally there's some tweaking of projects and dollar amounts between now and the February-March sales. And as you know, there's a 5-year plan as part of the CIP with, of course, the next year or the first year being the most critical in terms of bond sale. Some challenges from that we see going forward, and I'm sure council is aware of as well. First of all, because the two parallel, the operating budget and the CIP budget, both parallel one another in terms of time and calendar for development, it's difficult to give both the full attention that they need. And that's certainly a challenge that we've had, and even in this last year, putting together the CIP was a little bit hurried towards the end and a challenge for us. Of course, the other challenge on the general side is that the capacity projections are really dependent upon the roll that comes out, and that roll has become later and later, July 25th typically, and then into early August now. The project scope is not always fully known. I believe when Jim presented on the Better Streets Waco program, he talked to you a little bit about the work that they're doing now where they'll plan a project and they'll go out and do core sampling on that street and determine that the base of the street perhaps is in such bad shape that the scope of the project has to move from what might have been a fairly typical maintenance program to more of a full reconstruction, which certainly adds dollars to the process. The other thing is there's no formal discussion by a CIP team, and by that I mean a group of staff members who work together to come up with the projects, and certainly as part of that there's debate, there's collaboration and innovation, and all those things at the staff level can really produce what I've seen as a better plan overall once all that input comes in and then rises up to the manager's office. So as we think about the proposed calendar, this calendar before you here shows a couple of different scenarios. You'll see in both cases, though, that there's more regular interaction with the Budget and Audit Committee of the Council as the CIP is developed. And both of these calendars contemplate the CIP development really being broken away from the operational budget development and extending on into the last quarter of the calendar year, the first quarter of the fiscal year, with budget and audit and different items and actions taking place with the Budget and Audit Committee over that final quarter of the calendar year. The top scenario, the most pressing and really calendar affecting action is issuance and approval of the notice of intent to sell. And by law, that has to be 45 days in advance of the sale. So you see there, if we're targeting a February March, April kind of sale and closing timeframe, you want to have that NOI done in early or mid-December, and that allows you to approve the sale in February. The top one looks at that same calendar approach, but then having the CIP approved at the time that the notice of intent to sell is approved, and that would be in December 15th or so of the year. The bottom one is a little bit different approach where the notice of intent is issued again in December, and it's issued with a not to exceed amount that's usually higher than what you think you're going to sell, but it gives you that notification parameter. And then later on, you approve the CIP and the ordinance approving the sale in February. So buying you even more time in the process. So I guess the first thing that we wanted to present to council and maybe get your thoughts on before we move forward, Mayor, is does council have any concerns with this approach, bifurcating the CIP development from the operating budget development, extending it further into the last quarter of the calendar year and proceeding along one of these two guidelines? Or are there any thoughts or concerns on council's part with this approach?
John, I see your, go ahead.
Oh, yeah, no, so I mean, I think this makes sense. My only question would be, I mean, part of the part that did make sense about doing it in kind of conjunction with our budget discussion was knowing just how much we needed to allocate from O&M to debt service in terms of our property tax rate. So I'm just curious as to how, I mean, if we extend this past when our budget year starts, how we know when we adopt the budget in October, what our debt capacity and the rate would be on that front.
Yeah, that's a great question. Typically, because we sell in March to April, the debt service on that sale doesn't occur until the following year. So it gives us some more time to do a projection here and moving forward, and we'll have a better sense of what the values are. So because the debt service actually kicks in the following year, it buys us some time there to do better projections going forward. So we're still able to set the debt rate on the debt that's issued and obligations that are already out there.
Okay, that makes sense. Other than that, I mean, I think again, like you just said, buying you some more time, giving you a little longer runway to, and providing more discussion at the council level in terms of what projects we're looking at and kind of how all that kind of plays out. And all this makes sense to me.
Okay. Any other? All right, so let's move on talking about debt capacity and those projections. And this, I think, will kind of feed into the whole notion of more time in the process. So I'll move on to our next slide. Sorry, get out of this. Get me out of this. Share that one. Okay, now minimize them, please, so I can see where I'm going. All right, we'll start here. All right, sorry for the technical difficulties here. All right, when we think about debt capacity and the elements of that capacity, there's really a span of control for us as a city and what we can control and how that affects the rates. On the low side, in terms of area that we really don't have much control at all, is the taxable value. And that certainly is set by the county appraisal district, and that's a number that we have to work with when we get it. The collection rate, how much of the taxes we'll actually collect is another thing that's provided by the county. So those things are pretty much out of our control. In the interest rate, I kind of put that in the middle because there's a little bit of both involved. Certainly the market is setting that rate, and we don't have much to do with the market except through our financial policies and our financial planning efforts. That tends to give the market more comfort. When they have more comfort, rates are lower. And then, of course, the high side is the debt rate itself. That is governed largely by the amount of debt that we sold and the amount of debt we intend to sell in the future and how much we want to charge on the debt rate side. Similarly, looking at how do those different factors or elements affect the capacity amounts? Looking again, collection rate has a minimal effect as you run those calculations for debt capacity on the general side. Certainly the interest rate does as well. But the real driving factors for debt capacity on the general side are value, the taxable value, and the debt rate. And we're going to talk through some of those here. When you talk about value and rates, you're talking about penny shifting in a sense here. I think this table or this chart kind of shows you some scenarios based on a 5-year debt capacity scenarios with assuming a 2% interest over 20-year term, just for comparison's sake. And you'll see that the TAV is on the left side of the column there in blue, and then the pennies shifting over from operations to debt across the top there in tan, and then the numbers underneath it. And you'll see that generally, and these are just averages, but the intent is to give you some sense of what TAV means to the capacity calculation and what penny shifting means to the calculation. So generally, with those parameters assumed above, the 1% increase in TAV generates about 12 million more at each 1% increment over the 5-year period. And you can see those numbers going down the page. If we look at penny shifting, if we take, let's say 25 or a quarter penny or 0.25 of a cent penny shift over, you can see that it averages, about $21 million increase in our CAP capacity, assuming no growth in the TAV in that first zero column, and then you can see how it affects it going forward. So as values go up and as pennies are shifted over, obviously it drives up our capacity a great deal. For example, and this is kind of a worst case scenario, if we didn't shift any more pennies over and our tax base didn't grow for the next 5 years, our debt capacity would be somewhere in the range of $22 million. So the intent of this slide is just to give council some sense of, as we look at these different elements of debt capacity, what each one means overall in the scheme of dollars available to us.
Hey, Paul, this is Holmes.
Yes, sir.
I had one quick observation on this, and the penny shifting is always sort of, I wish we could go to ratio, and John mentioned a little bit earlier, ops to debt ratio. Where does our general fund, what percentage is it right now? 70, I know it is, I don't have it here, but 75-25 roughly, or 78-22?
I believe you're talking about the debt rate versus the O&M rate, how much each percentage?
No, I'm just talking about what percentage of the budget goes to service debt, what percentage goes for operating, annual operating,
I'd
running
say
the city.
75-25 to 80-20 probably would be
right in there. But and to me, that's what we need to be. Again, penny shifting, cool. But for my edification, can we start talking about the ratio? Because that, to me, that seems, that's what we're getting at here. Is
Right.
it 75-25 or is it 80-20? And that always confuses me. We're shifting a penny, but maybe everybody else is perfectly clear on that.
Sure. No, it's a good way of looking at it, a different way of looking at it. We can certainly add that in as we go forward in terms of options to look at, sure.
Because it seems simpler to say, just for debt service every year, we're pushing 20% of our budget to service that debt.
Right.
And do we want that to be more or less, or the penny shifting is like a point of reference for who knows what?
Yeah, I understand.
But
Yes, sir.
it's easier for me to tell the public, hey, 20% of our debt, 20% of all of the income here is going to service debt.
Sure.
And are we comfortable, moving that around?
Right. That's a good point. Good way of looking at it. We can bring that forward certainly as we look at this further in the future. All right. Again, and getting to Councilmember Holmes' point really, and talking about how these pennies are shifted and where the dollars are going. When we talk about these ratios, when we talk about our 5-year capacity and looking at what it is, in top left there, you'll see the graph that shows at a half penny a year moving over at the various different TAV growth rates, how much debt capacity we're talking about. And that could range from, if we're shifting a half a penny a year over with no TAV growth or zero growth, that's going to put us right at $63 million. And then across the board going up. And you'll see right around that between 4 and 5% mark of TAV growth, you really start making hay when you're moving pennies over. You can see that the pennies start increasing to just under 9 to almost 1.5, and then almost up to 2 pennies shifted over whenever your values start climbing above that, let's say, 4.5% range. And that's because of the 3.5% cap that we have from the state. And then as we exceed that amount going forward, we're able to shift more and more pennies over to debt. And that's reflected there. So it gives you some sense of how the curve works in this case. And you'll also see in the table below, the fourth column shows the average O&M revenue growth. And that's something that we have to keep in mind in all of this as well. And I think it gets to Councilmember Holmes's point. If we say that debt's going to be 20% of total revenue, and that's our target, as we think about those numbers going forward, value certainly has a part to play in that. And when we look at shifting dollars over or pennies over and our growth does not keep pace, then we're cutting into that O&M growth. And I think this next slide really drives that point home. And it shows you, assuming we're shifting $0.015 annually over to the debt side, if we have no growth, we're losing a little over $500,000 a year each year. So over the 5-year period, our operational growth would go down a little over $2 million. Then you see at 1% growth, we actually make a little money in terms of revenue, but not a lot. It's about $500,000 over 5 years. And then at 2% growth, if that half penny is shifted over every year. So it gives you some sense of, as we look at all of this, there's some consideration that needs to be given to operational revenues and what that means. And just as an example, certainly something that we talk about a lot in the manager's office is, a 1% raise for all of our general fund employees cost with salary and benefits, just under $1 million. So the need to preserve some revenue growth on the operational side is certainly important as we move forward. Projecting the TAV is a challenge, and you can see when we're looking at the years from fiscal 16 to fiscal 20, we were averaging right at 7.5, a little over that per year in TAV growth, and the median was right there with it, around the same 7.5% or so. So we're on a pretty good linear trend there. If you were looking at a projection between 16 and 20, you'd feel pretty safe about following that slope of that line and coming up with an estimate of what you thought the TAV would be in 21. However, in 21, we can see the line got flat really quick. We had about a 1.3% increase in TAV from 20 to 21. So now the challenge becomes, from a staff level and a projection standpoint, is 21 an anomaly, or is it a future trend? And the previous years don't really matter. So that is a real challenge for us going forward. As council's aware, we had a significant amount of the last appraisal was in ARB at the time that it was presented to us. So those things further complicate our projections going forward, and projecting TAV is a really strong element in the whole capacity calculation. We're going to have to do a lot more work this year probably than we've ever done in terms of trying to get some background data together and modeling something that we feel comfortable with, that we can come to you and say we think that values are going to do this. But again, much more challenging probably this next year than it has been in the past few years.
Hey,
And to this as well, sorry, Hector, go ahead.
No, I'm sorry. I was just going to ask a quick question. I know, Paul, you were talking about fiscal year 21. In your opinion, and I know that it's, I'm asking a lot of you, but would you say 21, it is an anomaly because of COVID?
Well, honestly, I'm a little nervous about it, Councilmember Sabito, because the appraisals were done in January of this year, before COVID actually happened. And then after COVID, is when the values went out, and then that generated a lot of the appeals that the county received. So it's a little hard to tell. One of the concerns I have is income producing properties, or, such as hotels, apartments, and those things in the future. Next year, they're going to be able to come in and say, look, for 6 to 9 months of the previous year, my income was much lower than what it had been. So now my values are going down even more in the future. Sure. So I don't know if it's a long-term trend, but it might be a short-term trend for us to look at. And that's some of the work that we are going to have to do as staff, and inviting and welcoming as much outside counsel as we can get to come up with a good estimate.
I would be interested to see, as you guys are doing your research and doing your homework, I would be interested to see what you guys are discovering as you move along in the process,
Sure.
because I'm very interested in that as well. Just because I tend to agree with you. I don't know if it'll be a long-term trend, but I think it'll be a trend for the foreseeable future for right now. And so I'm just kind of curious about that.
Sure.
But thank you.
Yes, sir.
And I'll just add, I mean, those trends, clicking away at almost 7.5% growth over the last 4 years, that was, you can see why there was concern at the state level amongst our residents and taxpayers as to that continual growth and increasing their tax bills. But just having that headline number kind of masks, in 17 and 18, over half of that growth was from new value added. And in 19 and 20, the preponderance of that growth was just from value increases on existing properties. And so, in this year, when the value on existing properties kind of didn't move up, then you see that big drop off. And so, I mean, I think that, when we're forecasting out, I think it's going to be important to not only consider potential for just the fluctuation of value on existing properties, but also just it just brings into much more sharp relief and all that greater importance for economic development mechanism to making sure that we're adding to our capital asset base to ensure continued steady revenue growth to be able to provide the services that our citizens need to be able to have that revenue.
Absolutely. Absolutely agree with that. And trying to break down our taxable values so that we see what is new growth over the last 5 years, what's appreciation of the existing base, looking at personal property taxes and where those are going. And those are much more difficult to project as well, but trying to break it down into its subcomponents and then forecasting each one of those and coming up with a total is the direction we're headed.
Mm-hmm.
But great point.
So it's just good to break those components down on those, because you can't just by seeing that what you're showing us there, you can't really see that it was
Right.
New growth those first few years of that chart, and it's been valuation increases on existing properties over the last couple.
Yes, sir. So. Great point. And we can throw another one in there, the TIFs and the values that the TIFs are increasing at and what that's doing to us as well, because once it goes to the TIF, then it's outside of the general taxes. So all of those are factors to consider going forward. So I'm sorry, go ahead.
This Holmes, just one more comment, Paul. And this is, I really love this page here. It does tell a lot of stories. And and again, the 1% last year versus if you look at the 5-year overall trend, I mean, it's very good, right? And probably, we should be very happy that we've had that kind of value growth, and we've been able to put together a budget that serves the city's growing needs as the city grows too. But there are a lot of relationships here too, like how much debt can we ultimately spend out of this budget? What is our pavement condition index progress? That's kind of a big part of what we leverage into every year, and how much we can spend on that. And again, I want to get into that ops to debt ratio, how we move that around, I guess penny moving. And then really ultimately, then we're talking macro budget concepts about where we go with impact fees and stormwater fees and how that affects all this as well, because this is one source of revenue, right? We've got we're serving city utilities under other revenue sources too. Anyway, I like how you're putting the logic together here. Thanks, Paul.
Sure. Well, one of the things that we're looking for today from council, and again, we probably haven't framed it exactly the way that Councilmember Holmes has suggested, but I think the concept generally is the same. And as we put together our calculations and our debt capacity estimates, one of the things that's real critical to that is having some sense of where the council is at with regard to shifting pennies over. In the previous couple of CIPs, in some of the out years, we were moving a penny or more each of the 5 years. And certainly that's something that you can look at doing when you're at 7 to 8% growth. When you're moving that down to maybe 3% growth over the term, that penny to penny and a half shift a year really has a negative impact on the revenue on the operational side. So just as an example here, if we ended penny shifting completely and left the ratios as Councilmember Holmes described them where they are today, these numbers give you some sense of what that would mean going forward. So if we have zero TAV growth and we keep the ratios where they are today, we're looking at about 22 million total over the 5-year period. If we see a 3.5% annual TAV increase, again, that's stacked on top of each other. Each year is 3.5%. Over 5 years with no penny shifting, that's about $62 million. And as we're thinking about this, and as you're thinking about this going forward, we've talked at least philosophically some about having $30 to $35 million a year in street improvement projects to get us towards that PCI rating that we're looking for. And you can see certainly at no shifting of pennies or no change in the ratio, over 5 years, even at a modest 3.5% growth each year, we're not going to come anywhere close to $30 million, $35 million a year for streets. So just that's one end of the spectrum that we're talking about. Another approach that we can look at that would be helpful probably to staff is to set an amount of maybe a slight increase in that ratio of between, let's say, 25 cents of a penny or even half of a penny, and using those parameters as we develop TAV projections and other things, and pull all of it together with some scenarios that says, okay, at 25, a quarter of a penny, at moving that, what that means to us in terms of total capacity over time, maybe another one at 50, and giving council some things to look at there. But those are areas where I'd like to get some thoughts from council today in terms of how you see that shifting, if you want to preserve the ratio as it is today, or maybe shift it a little bit over time. What your thoughts are, again, recognizing that as you shift those pennies over, just think of a quarter of a penny or 25.25% shift is about $250,000 out of operations moving forward. So as you think these through and give us your thoughts on it, maybe that gives you some guidance in terms of what the financial impact of those things would be. So we certainly welcome any thoughts that you have here, guidance that you could give to staff as we move forward with some projections.
I mean, I think that, I appreciate Jim's suggestion, just understanding it. I think from the technical side and the numbers, the penny shift to get the dollars in place makes sense, but understanding it from a more kind of, whole pie and what pieces go where to get a sense of the proportionality of how much is being committed for operations and how much is being committed to infrastructure investment through that debt service. I think it would make sense to kind of help future councils just kind of get a very high level, easily understanding when that pie kind of moves one way or another. I think that would help and kind of maybe clarify this discussion a little bit.
Okay.
For my own sake, this is going to be y'all's decision. by the time I'm gone. But I just say it makes sense to me to have some benchmark of where threshold where you like to see debt service as a percentage of your total collections. So you know how much wiggle room you have, and maintaining that, which kind of correlates to that second, plan little shifts over, as revenues grow, plan shifts over to the infrastructure side, not only to make sure you're having some of that funding dedicated to the needed infrastructure and the roads and whatnot get their proper attention, but also maintaining, some efficiencies and some constraints on just operating revenue growth, operating revenue expenses too, just to keep an eye on expenses to where, if you have a great year, it's not all going to, and you want to spend of it, you still have some constraints on that. And just keeping, there's some fiscal responsibility and some forced concessions and decision-making that need to be happened if you have sort of those constrained ratios on that, and that planned moving of some proportion of revenue growth over to the debt service to make sure that the infrastructure is properly funded. So I think y'all are approaching this in the right way. I think what you're suggesting and the way you're thinking about this makes a lot of sense. And I mean, for my own take, I think having some plan shift over to make sure that debt is adequately accounted for, to make sure there's some increasing resources for infrastructure investment on the debt side makes sense.
Okay, thank you.
Yeah, this is Holmes. Yeah, I like, it seems like we're going the right direction on here, just trying to more the optics, seeing what goes where from a ratio perspective. Just do, and I think I've seen this before, maybe that's in another budget and audit meeting, but projected debt capacity, and maybe it does correspond back with the other page 49 here, but with the overall debt and and I know it's in the CAFR too, I can look at it there, but what does the current debt of the city look like? How does it roll off? What can we see as putting new debt in at very good, it's a very efficient market right now as far as interest rates, but we're looking at that year to year. But how, and it all kind of has to fit together. What's our rolling off debt? What's our new debt? How does that affect? And one of our, I hate to keep coming back to the PCI, pavement condition index, but that was one of our goals that we had and want to maintain that. What infrastructure do we need to put in place? How much of that can we leverage into each year? How does that sort of grow or stay the same? Or how much can we afford to leverage? Or because we really need to, I think we need to know that cold at the beginning of every budget year. And we do, but just, and how do we project into a 5-year plan and at the same time increasing or making progress to that PCI and supporting the other, all the other infrastructure plans that we have in Waco. And this is a good start. I love it. I can't really give any guidance on whether to push more into the debt side right now. I mean, it makes sense, but I think we need a few more months also to see how this budget works for this coming year. That's why going back to the other part where we have a little bit of vision into what's going on through the end of the calendar year before we put the debt in place, I think is a good idea.
Okay.
But I guess if you're looking for advice, I would like to see some of that other data first, or that other, how do we grow into it, make progress on PCI, and I'm not afraid of debt. I think we're in a good position here in the city to take advantage of some the low interest rates. But still, we got to be careful about how much we burden the city with.
Right.
Hey, Jim, and I guess I have a question for Jim and John both, or Councilmember Kennard and Councilmember Holmes, I'm sorry. So I think staff is asking for, do we want to shift a little bit right now? Are you guys saying that you'd rather see the other data first before we come up with an amount to shift over as a council?
Well, but I think this is looking forward to next year though, right? Is that what y'all are talking about, Paul?
It says we move towards a sale in February or March, recognizing that obligation, that debt service will hit the following year. We want to plan for it appropriately so that we're not overextending ourselves and getting ourselves in a bind.
So Paul, you would ask, you're seeking direction from council right now as to how much of a shift we want to make over?
Yes, sir. And really, I think what we're trying to get some sense of from the council is, as we had a previous plan of shifting pennies or more than a penny over to debt each year, without really contemplating the revenue impact on the operations side of the fence. And I think the ratio discussion that we're having now is a good one. That gives us some parameters that we can say, okay, let's just take a number out of the air right now. Let's say 20% of our revenues are going to go to debt. We keep that, and then as we project forward of what the TAV is going to do at 20%, let's say, that gives us the projections going forward, and we don't necessarily shift pennies at all. It's just saying that council set a policy of 20%, let's say, hypothetically, and then that is, as value increases, that's what generates more capacity. It's not penny shifting, it's that ratio applied to a bigger base. I think that gets us what we're needing from council.
Okay. Perfect.
So, I mean, I like all of that. I think that makes sense. To answer Hector's question, I mean, if we're looking ahead to doing something for our bond issuance in February that would be reflected on the subsequent year's budget starting next October, given what we talked about earlier in terms of assessed values and valuations as of 12/31 of this year, my expectation is that it's going to be this year has been uncertain. I think next year is going to be rough, just in terms of valuations, given kind of where we are economically and kind of what we've seen with the pandemic. And so I mean, if we're talking about doing something that would affect next year's budget, I would almost want to say we get a plan in place to look at this 5-year thing, but we don't necessarily do something that might curtail our ability to fund our operations or unnecessary or take away from that bucket any more than we have to in anticipating what this upcoming year and valuations may look like. In this instance, I think planning is great and having an idea for the long term, but for this particular next 9 to 12 months, until we see kind of what taxable values are and kind of what y'all are looking at budget wise next year as you're going through this process, I think giving you as much flexibility and space as possible on the operating side may end up being necessary.
Right.
Yeah, and Hector, I would respond in a similar fashion. If it's 80-20 right now, I'm kind of feeling like 80-20 or where we're at, ops to debt ops to debt is probably okay. And I wouldn't want to get too much more debt in there because I'm if we ever, God forbid, went through a decrease, it's not 1.33, but it's -1 or whatever. Then we have to start being concerned about, basic city services and that kind of thing. So,
Exactly.
yeah, I'm good with taking a longer look at it and keeping the ratio where it is.
Good.
And the reason I asked that question is because for me personally, I don't want to make a policy change right now that can definitely hurt us down the road without having the sufficient data that I think that we're asking for. And so that's why I just wanted to clarify what you guys were saying, because I think I'm on the same wavelength that I don't want to make any major shift right now, not knowing what the next 9 to 12 months are going to look like for us.
Mm-hmm.
That's very helpful. And just again, as an example, the current CIP and last year's CIP, we're anticipating that ratio increasing on the debt side every year, which means in particularly difficult times and low valuation times of low valuation, that's a dramatic impact on the operations side. So we'd like to rein that in a little bit. The ratio is a great idea. We can build a plan around that and come back to council at the next budget and audit meeting with that ratio in mind and just show you, okay, projecting different values, this is what the capacity would be based on the current ratio. And that'll be very helpful.
Yeah,
if that's council's direction today, that's awesome.
Great. Thanks, Paul.
Yeah.
That was a good presentation.
Yeah, I think that's a good way forward.
Okay.
I want to jump in and second all of that. I think that the ratio is the best way to look at it going forward. And also, Paul, just wanted to say, I know that this has been an absolutely hectic time for you guys in your office specifically. And I just really appreciate the hard work you guys are doing and the little things, the minutia stuff like we're looking at right now on the screen that you guys are bringing to us for guidance on that. I know that it's hard to stop a moving train, which is, kind of what you guys are having to do every time something like this changes, and it's changing all the time right now. So just appreciate all your hard work in this.
Yes, sir. Thank you very much. We've got a great team. Got a great team here at the city. Thank you.
All right, is there any further discussion of this item? If not, are there requests for future agenda items? Our next meeting date is October 16th, 2020, and we will stand adjourned at 2:41. Thank you all very much. See you this evening.